Welcome to the seventh session in Introduction to Fundamental and Technical Analysis. So the main focus of today's presentation is to teach you how to interpret the RSI and the MACD. So RSI stands for the Relative Strength Index and MACD stands for Moving Average, Convergence and Divergence. So these are two important technical indicators. So as always, Mrs. Saliya will guide you through these two indicators and how, more importantly, teach you how to interpret these two when you all are looking at technical charts. As always, let me remind you, this is the seventh session organized by SC Securities. And if someone is joining new today, I highly recommend that you all go and check out the previous webinar sessions under the heading Fundamental and Technical Analysis in our YouTube channel. So without wasting much time, let me hand over to you, hand over to Mrs. Saliya Gamagedara. Saliya, over to you.
Thank you, Charitha. Welcome all of you. For the seventh session, and as Charitha mentioned, we are going to take you all through the MACD and the RSI indicators. I thought of just taking you all through the MACD first, and at the same time to show you how we plot the indicator in the chart screen. You go to the indicators menu like this, and then you move on to MACD, and you can get the load the MACD into the chart. Now, if we first of all let me take you all through each and every line that are given here. The blue line is called the MACD or the MACD line. The red line, which is moving in tandem with the MACD line, where at the same time, you can see that there are crossings above and below, is known as the signal line. And all these vertical short bars that you see are the histogram bars. Now, these are the three types of lines that you can see in the MACD when you load it into your chart. Now, what are these? Is what we are going to look at. First, let me change that chart style to a candlestick bar chart, and I would like to take this price line out. First of all, just if we expand this a little bit further like this, then you will see these lines clearly. Now, as far as the MACD is concerned, which is also known as the moving average, convergence, divergence, we make use of two moving averages. That is the reason why on the sixth session, I took those two moving averages and explained about how the crossovers of the shorter time frame moving average is behaving with the longer time frame moving average. That I use the 12 period exponential moving average and the 26 period exponential moving average. Now, the reason why I did that is because when we study or try to understand the MACD, we know that the MACD uses those two time periods. If you go to the settings in the MACD indicator here, which is the format, you can see that the fast length is 12, the slow length is 26, and the signal length is 9. So actually, what it means by fast length 12 is this is the exponential period of 12, and the slow length is 20 is exponential moving average 26 period. Uh, Before coming to the signal length or the signal, that 9-day period, let's look at the MACD line. Now, when we are using the MACD indicator, we always have to focus on the behavior of this blue line. You have to stay focused onto the blue line. Now, how to arrive at the value of the MACD? What we do is we subtract the 26-day exponential moving average value every day by the 12-day exponential moving average, right? You deduct the 26 exponential moving average value from the 12-day exponential moving average value. If we plot those two here, you will see, let's change the shorter time frame to 12 and keep it as in blue color. And this is the longer time frame exponential moving average, and I'm going to change the color to red. And we will see how the values are changing. Right now, you can see over in this bar, stay focused onto this blue colored bar, value. You will see the value is 123.49. To make things easier, let me take you all through another counter. Let's go with Expolanka. Right. The value in blue is 4.6701. And then you can see the red, which is here, which is in front, is 1.8629, and the other value in red, which is at the corner, is 2.8072. First of all, I mentioned that the subtraction of the 26 EMA by the 12 EMA is the MACD value. So the MACD value is 46701. And if you concentrate on these two values, you will see that the 12 EMA is 60.7969. You subtract that by the 26 MR value, which is 56.1267. Then you get 46702. In the case of this, they are showing 7601, just almost there. That is the MACD value, which keeps changing every day. Then I mentioned that the histogram bar value, I'm sorry, that's the MACD value. Then you have the signal line, right? Once we get the MACD value, we have to understand that the signal line is the 9-day exponential moving average of the MACD values. So some people, they kind of misinterpret the MACD, the signal line as just another 9-day exponential moving average, just like what we used here. It is not the case. This is the exponential moving average, the 9-day period of the MACD value itself. In other words, to put it simply, the signal line is arrived by taking the values of the MACD for 9 days and then arrive at the value of the 9-day exponential moving average based on those 9 values that we have taken on the MACD. So we have to understand that the signal line is the 9-day exponential moving average of the MACD line, right? Not the price. Now, when we are taking the moving averages, we take the 12-day or 26-day moving average of the price. In the case of the signal line, it is the moving average of the MACD line itself, right? So that you can see is at one over there. You can and even here you can see 1.8629. Other thing is the histogram bar value. Now the histogram bar value is the subtraction of 1.8629, which is the signal line's value, by the MACD, which is 4.6701. 4.6701 minus 1.8629 will give you 2.8072. That's how you arrive at those values, right? So that's a basic thing that we need to understand when we are looking at the MACD indicator. Now, to interpret the MACD indicator, or the purpose of us using the MACD indicator is, I would say, threefold. One is to understand this, the zero line or the center line crossover. One is that is called the center line crossover. The next one is the signal line crossover. Center line crossover and the signal line crossover. Then the other useful purpose of the MACD is to understand the divergence. So what is the center line crossover? Once again, let me enlarge this a little bit. Right. As I mentioned, we have to stay focused on the blue line, right? And the center line is this zero value. The zero value, I mean, the center of this indicator is a zero value. When the MACD line cross from above or below the zero line, that is known as a crossover of the zero line or center line crossover. The signal line is when the MACD line crosses above or below the signal line itself. Now this is the signal line. Red line is the signal line, and the signal line crossover is when the MACD is crossing from above or when it is crossing from below to the up, is known as a signal line crossover. When it comes to the MACD, or rather the histogram bars, what happens is the moment this crossover takes place in the signal line, you will see a zero value in the histogram bars, right? So then the histogram bars will, behave above the zero line or below the zero line based on the MACD line and the signal line. The reason as to why we are using the histogram bars is predominantly to understand that thing called divergence. So let's look at the divergence scenario later. Now, what is the importance of having these crossovers when it comes, for us to analyze a stock? Now, if you look at the price behavior, let's go back a little bit and start. I would like to take the volume away. Right. you can see that the prices have behaved based on, let me see, fine. Okay. Now, give me, sorry. Let's take it from the zero line crossover itself. We have to go move a little bit further then. First, let's take the center line crossover. When we are focusing the center line crossover, we need to understand that, we have to always look at the blue color MACD line, right? The essential part is that it is the blue color, or in other words, the MACD line, which is in blue, is what has to go up above the zero line or the center line in order to make a crossover or to spot a crossover above the zero line. So you can see that around this period, that is around 18th or the 17th of June, the blue MACD line has crossed above the zero line, right? Then going forward, the blue MACD line had been staying above the zero line for quite some time, until this point, right? Until this point. And then again, we can see that the crossover above the zero line takes place around this period, where the MACD value increases above zero, right? So at this point, and how does it happen? You know, the zero line crosses above, I'm sorry, the MACD crosses above the zero line when you see the shorter time frame exponential moving average crosses above the longer time frame moving average. When it pierces or touches or crosses above or below the MACD line, crosses above the zero line or stay above the zero line, right? When it is crossing below the zero line, I'm sorry, crossing below, meaning the 12-day moving average crosses below or touches the 26-day moving average, you can see that the MACD line, which is in blue, is touching or crossing below the zero line. At the same time, if you closely analyze the center line crossover, that shows how effective the rally up and down happens, or rally or a pullback happens in the prices. If you look at, if you come to the present situation, you can see at this point, the zero line was crossed over, and how the price momentum had started gradually moving up over here. If you take somewhere around this period, you can see how the prices also had started going up. Basically, what happens, once again, I must remind that it is not the MACD line helping the prices to move up. We have to get the idea that what happens here is that there is a positive change in the price behavior, which transforms into a positive move in the moving average value itself. When that happens, in order to confirm that, we look at the MACD blue line to see whether there is a crossover above the zero line. When we see that there is a crossover above the zero line, that confirms our analysis or our assumption that there is a tendency or an indication that the prices have started moving up. And when the prices are going up, we also have to remember that what is happening to the lows and the highs. First of all, when the prices start moving up at the start itself, the lows have to increase. Now in the over here, you can see this low is at 43.10. This is at 43.10. Over here, it is at 43.90. And you can see gradually how the lows are increasing. When the lows are increasing, the next followed by the lows will be the highs. And the highs also have to make higher highs. When the higher highs are in, when the shorter or immediate highs are increasing day by day, it will break out the previous highs. Over here, you can see that there is a previous high that was broken here. So the MACD centerline crossover primarily happens when the 12-day moving average crosses above the 26-day moving average. Now the next crossover is the signal line crossover. The signal line crossover happens more regularly than the zero line crossover, right? When the prices are within a trend, within an uptrend or a downtrend, there will be movements in that MACD line against the signal line. If you look at this crossover coming from above, cross below, and you have a downtrend which had continued till up to about this period over here, right? Then again, when the prices are moving sideways within a consolidation, you can see that the MACD line, let's take this histogram out, you will see how the MACD line has crossed above the signal line, then after a little while crosses below, then crosses above. That is, within a sideways movement. So that's one of the drawbacks when we are using the signal lines. When you are using the indicators, especially at a time of consolidation, when the prices are going sideways, especially the closing prices are almost going parallel, you will see these are also known as fall signals, right? So end of the day, basically when we want to encourage somebody to use the MACD, what we say is just the moment it crosses the MACD line crosses above the signal line, we will encourage people to buy. Then when it crosses below the signal line, we encourage people to sell. But actually, there are limitations to that. And one of the the main limitations is when the prices are moving sideways. So as a result of that, it's just, even though we are loosely telling that, it is not the real benefit that you get from the MACD indicator. So personally, I don't encourage anybody to just buy or sell by looking at the MACD line crossing up or crossing below the signal line, because that misleads and then frustrates the person who is going to use it. So we have to the lesson that we need to learn from using the MACD lines is to understand how the moving average itself is behaving, right? How the moving average is behaving in relation to the price behavior. That is the idea here, right? So please remember that when we are using the MACD line in a zero line crossover or a signal line crossover, we need to always look at the price action, right? How the prices, the lows are behaving, how the highs are behaving, and is it within a sideway movement, or whether there are breakouts above previous highs or below the previous lows. If you do that, you will be able to successfully use the MACD indicator when you're analyzing the charts. The next indicator, as we mentioned, is the RSI, which is the relative strength indexing indicator. In the case of the relative strength indicator, the formula is quite complicated. As a result, the message that it gives you is what is important. The message, or rather the interpretation of the RSI indicator, is to understand the relative behavior of the indicator as against the momentum of the price or the price behavior. And for that only, the RSI is a very, very important tool, which if used properly is going to help you in a in a profitable way. Both of these now, okay, if you look at the RSI, you can see that there are two horizontal lines, dashed lines at the top, which is at the 70-point mark. And incidentally, these RSI values can be seen either here. This is the current RSI value, or you can see over here. When the RSI value is crossing above the upper line, the dashed line, which is at 70 points, it is by, that is the basic interpretation of an overbought situation. When the RSI crosses above 70, it is considered as overbought. And when the RSI is crossing below 30, it is considered as oversold. Right? It crosses below 30 over here. That was last year. And when the RSI is crossing above 70, this is crossing below 30, and this is over 70, is called either oversold or overbought. In between is known as the neutral area. The other thing that we use both of these indicators is to understand the price change in terms of the divergence. So first of all, let's take the MACD and find out how that divergence is happening. In the case of a divergence, we need to stay focused on the lows to find out the bullish divergence. We have to stay focused on the highs of prices and the indicator to understand the bearish divergence. Now, what those bullish and bearish divergence? In order, when it comes to the MACD, most of the time, it will be, as I mentioned, the histogram bars will be used to interpret the divergence. As a result of that, let's take the MACD line and the signal line away. Now, when we look at the, in certain instances, we can see clear indications of divergence, and in certain instances, they are not really very accurate, or they are not prominently seen when it comes to those reversals or some developments by using these divergence. When we are looking at the bullish divergence, what we do is we stay focused onto these lows, especially when it comes to a downtrend. We look at the lows, how the lows of the price bars are behaving, and at the same time we look at the lows of these histogram bars are behaving, right? That will help us to understand whether there is a change even though the prices are falling, whether the momentum is turning to the upside or to the opposite direction. That is what it means by a bullish divergence. Now over here, you don't see that bullish divergence happening, meaning the prices are reporting lower lows, but whereas the bars or the histogram bars are not showing us any indication of that. But if you look at into the past, especially here, it comes to this period, right? Over here, we have to just see whether there are any indications for Expo Lanka as far as the bullish divergence are concerned, right? We don't see in Expo Lanka a bullish divergence by using the MACD. No. In the case of Expo Lanka, we don't see a bullish divergence. Let's go to another count and see, or otherwise let's while staying in the counter, let's take the RSI and see whether there is the bullish divergence indicator or other indication is visible in the RSI. Most of the time, more than the MACD, you see a bullish divergence in the RSI. Okay. Now we don't see a bullish divergence in the RSI itself. So as a result of that, first of all, we need to look at the MACD by using the signal line and the MACD the center line crossover and understand what is going on in the stock of Expo Lanka, right? Now, as I mentioned, for quite some time, the MACD line stood above the zero line, right? So that happens when there is that bullish momentum, major rally is at play. That is, once that happens, once again we move into a consolidation, right? In Expo Lanka, we can see that with that consolidation, the MACD line is touching the zero line whilst the prices are moving sideways, and then slowly we can see that there is a reversal to the upside, and but even then the MACD line is almost trending alongside the zero line. Thereafter, we can see that from about May, latter part of May, once again, the MACD line slowly moving above the zero line, basically distancing away from the zero line. When you see that, you can see even the histogram bars are expanding and the length of those histogram bars are also increasing, right? So when we can see, I mean, when we are moving into the present few days, you will see that the MACD line has distanced quite a long range from the zero line. We have, as a result of that, this behavior of the zero, the MACD line as against the zero line is very important. Remember, I mentioned that the reason as to why the MACD line is crossing up or below the zero line is when there's a cross of the 12-day moving average from the 26-day moving average. In other words, what it means is that the shorter time frame price behavior in relation to the longer time frame price behavior is either becoming positive or negative. When the MACD line is crossing above the zero line, after a consolidation is what is very important when we are taking positions in a counter. In the case of Expo Lanka, as we know, we have moved into all-time high price areas, and then we saw a major consolidation, a sideways movement that took place, where a lot of investors started accumulating positions. And at that point, if we are using the MACD indicator and understand how the MACD line is behaving alongside the zero line, that is going to be very important. One of the examples I would say is HECAP right now. If you look at HECAP, after this major split and the split adjustment, right, we can see how the prices or the MACD line is behaving alongside the zero line, right? So this shows that that this counter is trending sideways in a consolidation for a long period of time. When if you look at the earlier Expo Lanka consolidation, the length of the consolidation of HECAP is much longer than that, right? So any breakout above to the positive in the price can be seen if we see a continuation of the MACD line moving above the zero line and distancing above the zero line within a range. And if that range is going to increase, that's going to be very, very important for HECAP. So that's how we look at the crossovers, and each and every individual stock we can analyze by using the MACD. And as far as the crossovers are, as far as the divergence is concerned, we don't see any divergence for the HECAP even. The other important factor about the RSI is that there is this perception that when the RSI is crossing above the 70-point mark, that it is overbought. But at the same time, we need to understand that there are two interpretations of the crossover. One is crossing above the 70 points. Other one is crossing below the 70 points, right? Anytime we are talking of crossovers, right, there are two points which are very important for us to understand. The start of the cross above a certain signal line, right, and the cross below the signal line, or that point in the case of the RSI, when the RSI is crossing above the 70-point mark and crossing below the 70-point mark, you have two different price values. If you look at the RSI over here on the 23rd of November 2020, the value had been within a range of 46.80 and 47.79, or because of the adjustment, it's 47.79. Otherwise, let's say 47.80. But when it actually came down here, you can see that is after crossing below 70, right? The RSI, I mean the price value, you can see a range between 147.50 and 167. So interpreting or understanding the RSI behavior in the overbought area is very important. The same goes with the MACD crossover. If you look at the signal line crossover here, the start is between 57 and 62.50. When the cross below happens, once again, you can see it's between 100 and 130. So you have to pay close attention when we are using these indicators in its true essence. You will be rewarded. Otherwise, it's not going to work, and it's not. It's not worth looking at the these indicators. Just on its basic interpretation, we have to really understand what it means and what it is all about. As far as the divergences are concerned, you can see that many times you don't see divergence happening either way. But when there is, we can see mostly, or I would say more frequently, the bearish divergence occurs more than the bullish divergence, especially in the recent past. If you look at now, the bullish divergence is when the lows of the prices are continuously giving us lower lows, whereas the lows of the indicator is giving us higher lows. The price, you have lower lows, and the indicator gives us higher lows. Similarly, you can see that when there is a bearish divergence, what we look at are the highs of the price. When the highs are higher, when we see a high formation in the price, if the RSI or the MACD highs are either going parallel or coming down, giving us lower highs, that shows a bearish divergence. Now you can see here, this high is lower, this high is higher. So there is a higher high formation. But if you look at the RSI over here, on the same day, the RSI value and the next, when it went up to make a higher high, you can see the RSI high did not match up to that. So the momentum was reducing, or momentum was weakening, even though we saw the strength of the prices were increasing, right? So this is a bearish divergence. Also, if you look at the histogram bars, you can see that despite the prices breaking out and hitting a high, the histogram bars were not contributing to that rally. That's another divergence. Most importantly, the divergence that we see here in the RSI is more more accurate when it comes to this particular divergence. So let's take another count and see how important the what do you call the present situation in terms of MACD and the RSI is concerned. Let's take LOLC, which is another counter which is trending at the moment, and you can see how the RSI is behaving and the MACD is behaving. Remember, from the January highs, the MACD line has come crossed below the zero line and started moving up above the zero line somewhere around April. Thereafter, we can see that it is staying above the zero line. So when the moving averages are increasing, we understand that the zero line, MACD line is above the zero line. So what does that mean? At the moment, the bullish momentum that we can see in the LOLC will stay as long as the zero line is pierced, or rather the zero line, the MACD is going to cross below the zero line, which is not the case at the moment. Therefore, MACD is suggesting to us that the resumption of the bullish momentum in the LOLC, which started somewhere around April to May period, is still intact. In other words, what it means is that even if there is a price fall, it's to do with a consolidation more than a trend reversal. So there will be short-term price, fluctuations, but it will be, when we are using the reason as to why we are using the price action and the indicators is to understand at which point it will be worthwhile for us to have positions. So basically, this is primarily what we can see from the two indicators. And when we are using the two indicators in their right sense, in their perfect interpretation, you will be able to make use of these two indicators more profitably, and you can have a strong analysis by using these two counters or other indicators. I think if we have any questions, I think it will be worthwhile clarifying them for these, basically these two indicators, whatever we have in the sense, whatever you all want to know, you can ask now.
Thank you, Saliya, for that excellent presentation. I think it was quite useful for all our users who are basically new in technical analysis. So that is the end of today's presentation, and this can be followed up by the Q&A session.
What is asking in the Q&A to explain the behavior of RCL? Yeah, let's take the RCL and see. RCL,